this change is so large, it's going to change the way all markets behave and interact with each other.
That's just a big step change in demand for people across the board, which can give some confidence to a market that's been flat for ages.
We have begun it. It's 2025. Markets are different now.
Why are you holding it at a very, very low yield when you've got the capital growth out of it?
Yes, I've made a fortune here. Now it's costing me a fortune to own this. I'm just going to sell this and move my money into something that gives me some income. The rate cutting cycle has begun. Curtis, we've been talking about this for so long, but it is here. The RBA have cut interest rates, and that is the go signal for a huge change in property markets all across Australia. I'm calling it, we are at an inflection point in our housing market. Everything that we've talked about, every result that has happened with some of the capitals doing really well and some capitals doing really bad and this big deviation in spread, it's all in the past. We cannot keep thinking like it's 2024. We are resetting frameworks because this change is so large, it's going to change the way all markets behave and interact with each other. We're going to make some bold calls on this property podcast and go through what this rate cutting cycle means. Curtis, how are you?
Yeah, great. It's fine. It's a pleasure to actually be able to talk about rates coming down.
Yeah, it's 4 years, man. 4 years. Yeah. We haven't had a podcast where we say rates are coming down. You can tell how excited I am, can't you? Hey, we have had rates
obviously
coming down.
Debt holders.
Yeah, I am a debt holder, big debt holder. I assume I'm getting more monthly income in my pocket or less outgoings, and that is the case for everybody who is watching this and has some debt, which I think is most of you. We are Australian Property Talk, so if you are disappointed by that could be true if you're looking to buy, but really most Australians are winners out of this, except those that have savings in bank accounts that are going to see a reduction in their savings income.
Yeah, and we always say, housing is a bit of a game of finance. And when you start reducing, obviously we've got 25 bips now,
yep.
But if you start looking forwards and going, okay, if there's going to be further rate cuts, maybe another 50 bips, 75 bips, you potentially getting 100 basis points lower than where we were a couple of weeks ago.
Yes.
That does change the dynamics across all the housing, like just generally,
Sure.
like across Australia and all the housing markets when you adjust rates by a relatively significant amount.
Yes, that is very true. I don't call this a relatively significant rate cut, though.
No, not one by itself, but like
it is one tiny little rate
if
cut.
you are looking maybe at what's going to happen and you
Yes.
stack 3 or 4 of them together over the
Yes.
course of 12 months, that's where you start to get some movement.
Yeah. It was really funny. I just said that and it reminded me of my daughter whenever I, do a little bit of exercise or I go to the gym, I come home and I go to my 2-year-old and I'm like, hey, darling, how's my muscles looking? Just as a dad joke. And she responds back being like, it's tiny, daddy. That is basically this rate cut. It is a very, very small rate cut, but it's less about the rate cut itself. It's about what it signals. It's about confidence. It's about momentum. It's about all the things that aren't exactly the 2.5% increase in borrowing power or that very small marginal reduction in your monthly expense from one rate cut. It's about all the other things that is going to trigger the conversation that we're talking about. The inflection point in housing markets is what I'm calling it. It's here. We have begun it. It's 2025. Markets are different now. Every market that sucked before is now like, I'm starting to look at these, crappy markets. And every market that's soaring or has soared, the affordable price points, for example, I'm looking at being like, I think that time in the sun is now over and we are having a rebalancing completely. And most people will be too late and will still be buying in different areas just following 2024 trends. But the future is a little bit different because of these rate cuts and the rate cutting cycle as well.
Yeah, so it's a little bit like you say. So when we go into an easing cycle,
Yep.
the investing, strategy, the markets that you want to have your capital tied up in are a little bit different to when we've been at basically a static, last 12, 18 months of very, very little rate movement and price rises being driven more by other things. So, like populations moving around, relative affordabilities, those types of things. Whereas now there's an actual debt effect that just applies as a bit of a blanket across the board. So like you say, I'm thinking, and obviously we'll probably unpack some of these in detail, but places like Melbourne, some bigger cities where you've just got that, if you're looking at, maybe rates being 1% lower, that's just a big step change in demand for people across the board, which can give some confidence to a market that's been flat for ages.
Yes, confidence is the word. Yeah. Confidence is the word. Our old company name, confidence is the word. That is what is going to be driving what's happening. And this can be a little bit hard. We have just gone through a big merger at Flint Invest. We are incredibly busy working on lots of different things associated with it. But am I right? Like, customers just feel like go, go, go mode. It feels like that when I'm having conversations again. It doesn't feel like on the sidelines. It feels like, hey, I'm ready to act. I want to make moves. There's more people coming out of the woodworks. There's existing clients coming out of the woodworks. People we haven't heard from for a year or two that are just, we send loan reviews to and never get a response back. And now it's like, hey, what's my updated borrowing power? I'm thinking of making a move. That has started. It's been a very, very busy January and February. And speaking to all my broker friends, they've all said the same thing as well. Yeah,
compared to 12 months ago when, things were very, very static. There wasn't that much interest or activity. Like a lot more at the moment. I think people sense a bit of opportunity, which is, coming to fruition, basically.
Are you feeling it in your conversations? Like Curtis does most of our phone calls.
Yeah, definitely a lot more in investors. Well, I don't know. We've seen a massive uptick in necessarily the actual contract of sales and purchases, but a very, very big uptick in the amount of people seeking out pre-approvals, trying to test their numbers.
Yes. It's a starting point there.
If the numbers are tapped out, being like, all right, well, can I do a trust? Can I do something different? Yes. Like, how can I find a way so I'm in a position to purchase in the next 3 to 6 months?
Yes. I think that's the starting point of demand. Maybe it's January and February as well, like the beginning of the year. People set their goals. People trying to work out, what do I want to achieve this year? Going to their 2025 New Year's resolution, set up my finances, perhaps an element of that. But it is now, late February when we're recording this. It'll be early March when this gets released. So we're almost through quarter one, or, we've made big traction through it. So the demand is there. Okay, let me go through these inflection points. I'm just going to go through market by market and just say up, down, below, and why. Let's go there.
All right. Sydney. We're in Sydney.
Sydney, up a lot. We are restarting. Sydney, I think, is in a decline period at the moment. It's going to be a very shallow decline period, a very, very small blip that has already started. It'll have a couple negative quarters, and then it'll start rising. I think Sydney will post a positive year now because of this change. And that has, what's the word for this? Room for upside. There's one big change that we should talk about as well, is the coalition government have come out and said, if we get in power, one of the first things we're going to do is relax lending laws. And they've gone even further, and they've said, we're going to tell APRA to wake the hell up and stop containing lending because they're being stupid. And I kind of agree with that. I'm like, you're being stupid. You're just like, it doesn't make any sense here. You're just digging in your heels. And the coalition has said, hey, we're the government, do what we say. That's going to be one of their first actions. Be like, yeah, well, I would do the same thing. I'm surprised. That could even create momentum on both sides of the equation, where the other party say exactly the same thing, being like, hey, hang on, it's a housing election. There's going to be housing is going to dominate this election a little bit. It'll be like one party's coming in being like, give 50 grand to first home buyers, let them access their superannuation, make lending actually work a little bit better.
Cut assessment rates, yeah.
Cut assessment rates. Labor's coming out being like, hey, what if we exclude help debt into servicing calculations? You can see the momentum on lending specifically, where it's just like, attention is being put on it. And, as we speak right now, I'm pretty sure, I don't really track this very closely, pretty sure the political odds say that there's one party is favourites, and the team that is favourites to win as of today is going to cut the assessment rate, which is huge for Sydney property. So it's going to begin rising with potential for a bit of a turbo booster that could happen from this.
Yeah, and I think my sense of the Sydney market is that access to debt, like when people can access more lending, they do, and they use it to upgrade their owner-occupier They use it basically in Sydney.
Yes.
So people, because house prices are high, people tend to be operating a little bit closer to their servicing limits than other markets. So when you move the servicing limit and the access to debt, prices move basically.
sure. Yep.
And all these factors that we're talking about are all things that are going to increase the amount of debt people can access. So rates coming down does that. Assessment rates changes does that. All these changes are in that direction. It's just a matter of how much, how fast. Yeah.
Exactly. Yep. Melbourne.
What are your thoughts?
We've talked about this a lot. Curtis, you know, our audience is from Melbourne, actually. We did the numbers on this.
Oh, really?
Yeah, 55% of our audience is from Melbourne. Hi, Melbourne. We didn't really know that because it is one of my favorite cities in the world. I was there last week. I absolutely love it. I did not know our audience is from Melbourne, so that's very, very cool. Melbourne audience, I think Melbourne's going to do really, really well. We've done a whole range of podcasts. Adi, a co-host on this very podcast as well. We'll keep doing it. We're going to go through suburb by suburb by suburb to help educate you because Melbourne is an obvious go, go, go because it's done nothing for 4 or 5 years.
Yeah.
Rates are coming down. There's so much different type of opportunities. Value signals are there, and the yield profile that Melbourne is getting versus the cost of debt is moving in the right direction. So because it hasn't risen in value at all. So it has a relative component there. And all these investors that are looking, they're just going to start finding Melbourne attractive again.
Yep, I think we've already seen that,
Yes.
just from the investors we work with. But yes, I feel like Melbourne, I'm obviously a bit biased because I got exposure to Melbourne, so I hope it booms. But like,
yeah, you did too.
Yeah. But I feel like it's one of the markets that's more susceptible to a little bit of a confidence boost.
It is.
So if there's a bit of a snowball effect of a couple of rate cuts, people feeling more confident, I feel like Melbourne is a market that would benefit from that more than others. People starting to feel a bit more confident. Which hasn't been there. It's been the opposite. There's been the taxes put on, investment properties, things like that. It's all been the opposite direction for the last few years. So a bit of a turnaround there.
I've spoken to a lot of Melbourne agents as well, and they've all said it.
They're feeling it already?
Yeah, they're already feeling it. They're just like, something's different. Everything's different. Like, what? I could barely sell a property now. Now I can find more boots on the ground, particularly that investor type stock. So if you've got an oldish home on a decentish block in around the 750 price point, anything sub million really, it's just like, hello. That's a little bit different. You got an investor probably selling it too. There's a lot of investor sales happening in Melbourne. Cash flows are bad, yields are low, so people want to offload. That is very, very normal. But at the same time, you have investors going, hello. So it's an investor selling to another investor. So that is there. For property investors, that's actually quite attractive as well if you're buying it off another investor because it shouldn't have that much of an impact on the rental supply kicking in. So it shouldn't impact your rents when you're just replacing one investor to another. What else have we got here?
Tassie is the next one. Let's stay down south.
There's a reason for this. I don't know the reason. Actually, if you're watching this and you're from there, can you put it in the comments below? Because I went to Tassie recently and I'm going again next month. And I really wanted to know. One, it is an absolutely beautiful, beautiful place. My bias is kicking in where I've gone. I'm like, I want to own a home in Tassie. I definitely do. It's so beautiful. And I can see so many retirees wanting to go there. I only go in summer, so that might be the reason why. But the thing that is interesting is there's been a big spike up in its rental appreciation in Tassie recently. While the rest of the country's gone down, Tassie's gone up. That signals more demand is coming into the housing market pretty quickly and fairly aggressively. Why? I don't know. That's the truth. Do you know?
No, and that's a very short answer. But whenever we've done a review, like the economic factors and the population movements don't seem to give an obvious answer to that.
Yeah,
like
short term. It's very short term.
It's not
Something's
like
happening.
A massive population boom and people coming in that explains it, or economic performance that you kind of look at and go, okay, there's a one-to-one correlation there that checks out.
For sure. It's also got a 4.3% yield, about 15% higher on its yield than Brisbane, Perth, Adelaide. It's a second highest yielding state as well. So you can start seeing, hey, it's a low yield still for Hobart. You typically get a bit of a premium on the interest rate, but now you're not getting a premium. You're paying every month to own a property in Hobart. But at the same time, it is becoming a bit more attractive where prices haven't risen again for an extended period of time and now rents are going up. So it's one that I would say will do well in the year 2026 if this continues, and one to pay attention to. It'll be on my early radar. We'll talk more about it, but like early radar. We talked about Darwin about a year ago or 2 years ago. It's like, hey, why would you ever invest in Darwin? We've made so many jokes about it on this podcast. People don't like us for that. But then we pivoted, being like, hey, Darwin was starting to look good. And then we pivoted really strongly and said, Darwin's looking really, really good, right? That was about 6 months ago. Hobart is one where I'd say it's in the early conversation now. We're just like, watch it. Like there's so many data points to watch. I'll be tracking Hobart data very closely because at some point I think I might be like, Hobart's back on. And it'll be based on early indicators like this rental appreciation that's there, like housing finance data, like some of the economic movements that we'd be looking at, the type of employment that we'd be going through. We'll be doing some analysis on it because it's something to look at.
Yeah, so Sydney, Melbourne, Tassie. So they're markets that haven't been running the hottest in the country.
Yes. The worst.
Yeah,
the worst.
Exactly. So they're ones
all up.
You might get a bit of a trend here that might benefit from the easing cycle more so than the markets that have been running hot. So let's maybe unpack them a little bit.
The hot markets, Brisbane. Let's put Brisbane, Perth, and Adelaide. Let's put Brisbane and Perth together. I think they're coming down from rapid growth rates. They're not even going to be double-digit growth rates, I think. So
they're going to return to the pack. And not even lead the pack, maybe.
Return to the pack. Yes, they're going to return to the pack because there's going to be one outlier that leads the pack. I think I've already mentioned it a few times, but there's going to be one outlier to all of this, but Brisbane and Perth are going to return to the pack. That means positive growth rates, but returning to the pack. Brisbane might just return to the pack completely. It makes sense because when you look at this, we're like, why are you investing in Brisbane now when the yield is its lowest it's ever been? Right? It's like a numbers game where like some point, some people are going to be like, I've made a fortune here. Now it's costing me a fortune to own this. I'm just going to sell this and move my money into something that gives me some income.
Yeah.
That's what investors do. They sell when the time is right. And nowadays, more and more investors are selling. I think Perth could be in for an investor. We're talking about a little bit more and more buyers agents are now saying sell, buy and sell. So the clients that they bought the properties for, they are now saying sell those properties. Because that change is there, we're going to see more supply kick in, more new listings kick into Perth that really crunches down its growth cycle, even though if the fundamentals are strong enough to keep it positive.
Yeah, and I think the positivity maybe around Sydney, Melbourne, Tasmania, other markets adds weight to that because you've got other places to put your capital, right?
Exactly.
So you can take, if you've made a little bit of money or a lot of money, depending on when you got into Perth, Brisbane, like these markets, why are you holding it at a very, very low yield when you've got the capital growth out of it?
Yes.
Take your money out, move it to Melbourne, move it to potentially like Darwin, Hobart, other markets where the yields are higher and you can get on the right part of the growth cycle.
Yeah, for sure. I call this tactics a little bit. If I'm playing tactics on a strategy board, Curtis and I play soccer every weekend. I love playing tactics on football, being like, yeah, we defend here, we score here, we move this way. I've got no idea what I'm saying. But when it comes to property, that's kind of in my wheelhouse. If I was playing tactics with property, I would be like, go back in time when rates began rising or when we thought that rates would begin to rise. That's probably the time to get out of Sydney, get out of Melbourne, and then repivot that money into affordable, cheap stuff where it just filters down. All the crappy stuff filters down, being like, that's what people can buy. So you can just buy anything cheap in cities that are cheap. That would have been Adelaide, would have been Perth, Brisbane at the time, definitely Adelaide and Perth. Just put your money there. Tactically, take your money out. Like, it's gone. It's over. This is the inflection point. Done.
Yeah, exactly. Yeah.
Get your money out of there tactically. If you've got your money, you've made your money, it's time to get out. That's the tactics behind it. Tactically, I'm selling out, paying my taxes, and moving the money into areas that do make sense. This is why, if I'm saying it, people are listening. There might be thousands of you listening right now. That is going to start bearing some impact and lots of people are going to start saying this. So that then means there's more sellers that are happening. And those sellers are going to fuel the very reason to sell. And then repivoting that same money into something else, you'd be looking at different markets. I think Sydney, Melbourne would make a lot of sense. And I think a lot of people are sitting there on their spreadsheets. They want to do this. They're just like, can I get rid of my Adelaide properly? I don't really want this. I don't really want to own in Adelaide. Yeah, it's risen a lot, but it's $1 million getting me 3.5% yield to live to own this Adelaide. I don't want this anymore. Why do I have this? They're thinking there, being like, do I really want this? Would I buy this? The answer to that is no. If you're doing this right now, I know you're thinking it, you're thinking no. That could easily mean, why do you own it now? It could easily be like, would I buy in Melbourne at a 4.5% or a 5% yield? Add in a granny flat, 6% yield. Would I buy in Melbourne for $650? Or would I own this property in Adelaide at 3.5% yield? It cost me $1 million. It's doubled in value in 4 years. It's a friggin' no-brainer. Tactically, it's just like time to get out and time to repivot into Melbourne.
Yep. Yeah, I think that's a pretty good summary. So like maybe to unpack a couple of the factors. So we talked about like rates coming down, like access to debt basically becoming easier.
Yes.
Like there's still the fundamental mismatch between like housing supply, housing demand. So all the forecasts for that are that there's going to continue to be a housing shortfall. So I've got some numbers here. 95,000 dwellings, like a shortfall between 2023, 2026 is what's projected.
Yep.
So and the fact that the economic factors look like they're holding up pretty well. So we're not going through, it doesn't look like we're going to be going through a cycle of very, very high unemployment, very, very negative economic growth that causes kind of widespread economic shocks.
Yep.
It looks like we're going to go through what is an easing cycle with employment in like Sydney, Melbourne, big markets that's healthy, and a housing undersupply, basically.
Yes.
So that's where the fundamentals are kind of going, okay, there's
pretty strong,
a few things stacking up together that means those markets should perform, pretty well. They've got all the hallmarks of something that should be rising.
Yes. I would say one of the big inflection points is massive growth rates in property capital cities. They're coming down. I would say all these hot markets are coming down to single digits, and the markets that are going to go up, they're going from -0 to small single digits. Like we're talking about a crunch in capitals and the growth rates between these cities. There's obviously going to be some deviation there. KPMG came out with a report with the best city at 4% and the lowest city at 1.2%. I'm like, it's not going to be that
tight.
That's not going to be that tight. That's just, I call it the
Well, model's got to spit out something.
Yeah, I could call it a ChatGPT model. I'm like, you could come up with something better than that, can't you? But it's going to be a spread, 5, 6, 7, 8%. Except one outlier I still think is going to absolutely tear it. And we'll talk about that more in a different podcast. But more specifically, I wanted to give a little shout out to us and you if you want to join us in a mortgage broking career. We at Flint are hiring, and we're hiring big. We're looking for so many people at the moment, talented people to come and join us. So if you would like to join us and you work in banking, you're a mortgage broker, you love property, and you're looking for a job or a change and want to work with me and Curtis, then jump on my LinkedIn. Read them, Sayed, at LinkedIn. You can look me up. My name's pretty unique. You'll be able to find it. Read them. You'll find it there, and there's a whole range of jobs there, and you could kind of reach out to us at jobs@flintgroup.au, and I will take a look. And I have a strong preference, if I can, to find somebody from this very audience. So anyone who's applying, if you watch this little segment, you'll get a little bonus point on our little selection criteria. If that's allowed, that is something that I'm going to go through. So the last couple of hires that we've had have actually come from here, and someone starting very, very soon has come from this very podcast and knows a lot about us and is fantastic. So I'm talking to you right now. If you're looking at this and thinking about a change, you're in property as well, we're looking for people, lots and lots of people. Also, Adi at Alaya, another business partner of mine working at Alaya, is also looking for other property people as well. So any sort of property minds, buyer's agent, mortgage broker, if you're looking for a change in career, then speak to us. We'd love to hear from you.